Good morning and welcome to the fourth episode of Mortgages Unplugged. I'm joined today in our studio with three gentlemen from the MBABC. I have Jason Suddy sitting beside me, and next is Troy Resvick, and followed by Geoff Willis. They're all on the board of the MBABC, and they're here today to talk about some of the things that have occurred over the last 24 hours. We all know our phones have been ringing off the hook. There's been lots of press releases about some of the changes that occurred today, or last night, I guess, Minister of Finance. So welcome to the show, gentlemen, and we're going to take the next maybe 25, 30 minutes and just chat about some of the changes that have occurred. So, Geoff, I'm going to throw it over to you. Why don't you outline what those changes were and maybe clarify? We were talking earlier, and there's a little bit of confusion out there. Well, it sounded to me like the minister came out with things that were both affecting to consumers, but maybe also affecting to financial institutions as it relates to some of how they deal with the investments of mortgages. One of the things that I think, well, not one of the things, but the key one that will affect the consumer is the change in the maximum amortization from currently 30 years to 25 years. So it just has some impact on people's purchasing power if they're trying to buy a home with less than 20% down. Right, okay. But as part of that messaging, they also talked about this sort of $1 million cap, this $1 million purchase price, which will be, if somebody's acquiring an asset, a home, greater than the value of $1 million, it will not be acceptable as an asset in a mortgage-backed securities pool. Okay. So that's an investor-related issue. It isn't a consumer-related issue. So immediately everyone thought that if I'm purchasing a home over $1 million, I can no longer get a mortage. I can only get a high-ratio mortgage, but that's not necessarily accurate. And I imagine we're going to see a lot of clarifying messages over the course of the next few hours about that, because I imagine there's lots of lobby groups and the real estate associations are going to the feds and saying, you know, what are you doing? Right. Why are you killing that segment of our market? Right. So I think there'll be some more clarity coming out on that and during the course of the day or the next 2 days. But I think mortgage brokers should know they get a qualified customer buying a home that's over $1 million, which is not uncommon in this marketplace with less than 20% down. There's still going to be a means by which to get those people financing. Great. Okay. And Troy, do you think with the reduction of the amortization from 30 year to 25, we're going to completely cut out our first-time home buyer market?
Well, it's certainly going to have an impact, and some of the numbers that we read last night and early this morning are indicating that that 5-year drop is equivalent to about 0.9 or 1% rate increase. So that's definitely going to have an impact on qualifying and first-time buyers for sure. Okay. And Jason, would you say that the TDS and GDS changes that have occurred, so we were at, you know, if a beacon score was nice and high, we didn't have to worry about GDS, and we could go up to 44%. But now they're restricting that GDS to be 39. Do you think that's going to influence anything?
No. We talked last time at the moving target that some of the insurers are working on when they underwrite files. They say their policies are one thing, but then they're a lot tighter, whether it was a GDS or a beacon score kind of thing. And when the rule was technically 0% or no GDS and 44 TDS, we were still seeing them qualify. I think the rule of thumb is always 35, 42. Yeah. It's still going to be that, and we usually live in that, and you're always going to be pushing the boundaries regardless. So I think of all the rules, that's going to be one of the least likely that's going to affect us. Okay. What about this last one, and that's reducing refinances from 85 to 80%? And these rules come into effect when? On July 9th. July 9th. And so is that meant that if you are approved for a 30-year AM mortgage today or July 1st, that's fine as long as the mortgage could fund at any time afterward? Is that how your understanding? I think that's fair. They usually have a rate guarantee of 120 days, 180 days, depending on the lender. So I don't think they're going to ever try and curtail or make themselves more busy by trying to have a rush to market. They want to have calmness in the market and allow everybody to get the financing they've got in place without having any changes to that. Right. So. Now, last time this happened, we had major mortgage changes. Everybody went crazy trying to get into the market before these changes took effect. Geoff, do you think we're going to have a flurry of mortgage activity over the next few weeks? So. Yeah, I think so. I think we're going to see a lot of people that maybe were on the fence about going forward and doing their refinance, now doing it. There might be some people that maybe bought a pre-sale condo in Vancouver and thought, I got lots of time to get my financing in order, and is now thinking, I need to get my amortization locked down. To Troy's point about transitioning rules, one of the things we learned already when we went from the 35 to the 30 is that anything that was already on the books, regardless of its closing date, even beyond 120 days,
it was still okay to stay at that 35. But if you came back as a purchaser or a broker and wanted to make changes, you wanted to increase the size of the mortgage, then you could lose that amortization.
Right.
So I think it'll be kind of that line in the sand that
Yeah.
if it's on the books, it's okay, but don't change it. Otherwise, you're going to lose what you had and default to 25.
Yeah.
So I definitely think we're going to see some activity, and I think we're going to see some further statistics come out from Camp and some of the surveys that they've done to suggest that most homebuyers, first-time homebuyers in Canada, are not buying to their max. They're actually making prudent home buying decisions, and this change in the amortization, while it affects their purchasing power, they're already self-regulating what they're choosing to buy based on that knowledge already, because they know rates are low and they have to accommodate for some sort of a cushion in the future. So I think consumers that are in the buying side are probably regulating themselves a lot more than the refinance customer that maybe has a need for cash.
I think our message too as mortgage brokers is getting out there where it's important that we take advantage or suggest to the consumer that they take advantage of all those prepayments to increase their mortgage payment if at all possible. If you're in a variable, make it like it's a 5-year term and make those payments to reduce the principal. The minister said that his whole reasoning behind this was that they would pay less overall interest and they would pay off their mortgages faster. And so that's sort of the message. And it's a positive message.
It is.
It's a positive message. So all of those, Jason, all of those people that were in 40-year amortizations, 35-year amortizations, when they come up for renewal, what's going to happen?
Well, I had a conversation with a couple of my contacts with lenders, and all the lenders at this exact point are having conversations with the insurers to make sure they have everything. Was it the same as last time? And as it should be the same as last time. If you're not making any changes, renewal. You've had 30, so if you have 35 years left on that, and you don't make any changes, they're going to acknowledge the 35 years.
They'll be grandfathered.
Absolutely. So, but no changes. So no more money. So whether you want to take your mortgage to another property, you want to do anything, you cannot have any more money. Regardless of who the lender is, if you don't change the money, the risk to the insured doesn't change. You still have that much money and it's still that much insured, so that's why they most likely will leave that the same. But I think one of the things that people do need to consider, if they're in that home and they're thinking about moving up, and one of the things they got that mortgage was so I can take this mortgage, I'll port it, I'll add some money to it, I'll move on.
Right.
If they're living in that 30, 35, you got to be careful of that.
Right, you've got to, okay. Troy, just on average, if I wanted a $300,000 mortgage right now, which might be a first-time home buyer, how much more income now will I have to make to service that $300,000 because I can no longer get a 30-year am? I'm down at a 25. Do you have any rough idea on that?
I haven't gone through and run the numbers yet, Deb, but really what we're seeing is most of the clients that are buying in that range, and I'm going to go back to the first-time buyer because that's really, that entry-level price for a lot of people. It's always about affordability. And as brokers, we are probably the best risk mitigators for our clients because we set up and give them the information as what those boundaries are, but really it's what's affordable. And so they might be able to qualify, usually it's sufficient income, but it's the other debt level that I see that what the minister is really trying to do is get people to be not just their housing, but the balanced load of their debt. And what we found is that first year where clients are purchasing a property, they're ending up with about $11,000 more consumer debt after a year of homeownership. That was about 80% of the clients that are buying first time. So really managing that little bit of risk, not so much an income question, but more, can we afford to take on the extra debt that we've got that goes with homeownership?
All right. And Geoff, we know that the first-time home buyer drives a market. If the first-time home buyer is going to be squeezed, do you think this is going to influence the housing activity or the sales in the future?
I think if that comes to pass, then for sure it's a trickle effect, right? It moves all the way through all the segments of purchase prices, but because we happen to live in a market that for first-time buyers is driven by multifamily, although we read all the newspapers articles about average prices, it's always driven by single family. That is not the target product for that first-time home buyer. So when they're buying, a home where they're going to end up with a $300,000 mortgage and it's in a condo or multifamily type product, the difference in this amortization in terms of their monthly payments and qualifying really is pretty small. You're talking about $4,500 to $7,500 a year in annual income to qualify for the difference because of the AM change. So I don't think it's going to have the impact. I think today and tomorrow and next week people are going to think about, but I think that will become more, as we as brokers begin to make our referral partners more knowledgeable and the marketplace becomes more knowledgeable beyond the sound bites, people go, you know, I can still do this. This still makes sense, and
Right.
I still want to live in that home. That particular home is still where I want to live, and they'll still buy.
So-
That's my feeling.
So Jason,
Yep.
why always mortgages? Why is the federal government hitting mortgages?
Why are they always picking on us?
Why
eh?
are they always picking on us?
Good question.
It's my fault. Well, I think there's honestly an element of it's easy. It's an easy one-shot deal to go after the insurance. You know, you're regulating 3 insurance companies, nobody else, and then that trickle-down effect affects all the banks. There's also the regulation. I mean, often when we have these conversations about consumer debt, the first argument I always hear is, why don't they go after the credit card companies?
Exactly.
They're provincially regulated.
Okay.
And that's the problem. It's how they're regulated, and you know, I think, you know, Troy and I talked earlier today about the difference. And some lenders actually, there's a lot of banks that actually do want to reduce their debt loads. They really want the best, and they get caught in this market. But to be honest with you, to give Visa a phone call to say, hey, you know, we think it's a good idea if you stop giving people cards with these kind of limits, they're going to hang up the phone on you. So I think that's the problem right there, is how are we going to execute a regulation to limit the consumer debt? We've all been to those hockey games where if you sign up for a credit card, you get a free towel and a credit card, right? That's the stuff that has to
Right.
stop.
That's right. That's right.
But it's interesting. I think to your question earlier, it's really because they can. You know, interestingly enough, I think the government's kind of in a sticky spot in that, in some ways, they just as soon not be in the business of mortgage guarantees, meaning that maybe they shouldn't have ownership of a Crown Corp like CMHC, but yet they can really affect public policy and real impact in the economy by virtue of having major influence on CMHC. So they're kind of, you know, in between both camps. And I thought that was kind of interesting that it was Jim Flaherty that made these announcements in advance of OSFI coming out with their final report. It was almost like saying, hey, you know, this has got a lot of political wind because of what's going on in other parts of the world with people in their economic situations. We want to show ourselves as a government, not as a regulator, to be concerned and to be thinking about all Canadian consumers. So, you know, I think it's really because they can. They can't do it any other place.
Do you also think, Geoff, too, I think this is, you kind of speak to a point, I think there's a lot of time is that because you can attitude, and if people are going to push the limit every time, the government runs that fine line of how much are we going to get involved. We'd rather you figure it out on your own, but if you're not, we're going to figure it out for you. And when it comes to consumer debt, sometimes I think that's the view they take.
Oh, for sure. Yeah, I mean, the banks are in the business of generating profits, and as much as they'll talk about we're selling savings, I mean, it's tough to sell savings at a 1.25% return and no capital gain. So you can see why mortgages are a much easier way to build, you know, cumulative market share if you're a big charter bank in Canada.
Well, they can't reduce rates anymore because, you know, things are just still dicey out there, and so I guess this is the next thing. Have we created, or are we creating a state of panic at all?
Well, I think anytime that you get those announcements coming out overnight, and you know, without a whole lot of warning or expectation for those types of announcements, you're going to have some shockwaves sent through the marketplace, and I think we're going to see that in the coming weeks here. But as more information comes out and the insurers start to release how this is going to impact, if we go back to when the 40-year was eliminated, that was a major crisis. And we were actually at a conference when they announced that, and you know, 1,400 brokers coming out going, what's going on with that? But it took quite a while for that information to flow from the insurers and from those lenders, how it's going to actually impact them, where they're going to apply and when. So I think right now it's a holding pattern. It's business as usual, but we definitely have some changes coming, and we have to prepare for those and prepare our clients for those.
I think this is a great time to reinforce the fact that you need to call your clients.
Absolutely.
Right? I mean, it's a great topic to be able to phone and say, I just wanted to clarify, don't panic, you know, these are your options, and you know, the goal here really is to pay off your mortgage faster. Yep. So I think we can move on to the next big topic, and that is the shutting of First Line Trust. The broker channel of CIBC, First Line Trust, is going to not accept any more mortgage applications as of the end of July, correct? Or July 31st? Yep. What are your thoughts on that?
I honestly, I don't know what to say. I've not been our brokerage doesn't do a lot of business with First Line.
Oh, okay.
I think that they were maybe they may be paid the price for some of the programs that they chose to invest in, particularly a token economy like points, where brokers could really acquire a ton of points that allowed them to provide a different kind of rates for their clients. So that affected maybe First Line's regular pricing strategy and how that affected CIBC's bottom line. I think that if you're a retail bank, right now, every retail bank in the world is doing well by having one brand. And they want to find a way probably to have one brand. I don't, if you look at CIBC in the Canadian landscape, I think if they didn't have brokerage, where are they building their mortgage book? Is it through their sales force? Is it through their branch channel? So we may see them reemerge under their own brand and say, we want branch fulfillment. We want to do the things now to continue to find a way through this channel to get the right kind of mortgage consumer.
Do they still have President's Choice, HLC? Those are still out there active?
Yeah, they are. Yeah. They are. So they have been that retail bank brand that seems to have their fingers in a lot of different names and a lot of different letterheads. So,
right.
I mean, who knows what's in their strategy? They've got much bigger brains than we do to figure out what the long-term play is. But, I think as brokers, we have to come to terms with the idea that we're all about choice, but we're not necessarily about 95 choices. We need to make sure that we
right.
bring unbiased advice to clients. But, as long as we have enough players to play with, it doesn't really impact our ability to be effective.
Do either one of you use First Line on a regular basis?
I used to, and I actually used to work at HLC. So, they mentioned they're not taking any applications about July 31st. To be quite honest, based on their pricing, they stopped taking applications at the beginning of the year.
A year ago.
Yeah,
that's
absolutely.
Right.
So
right.
This decision is not a surprise to anyone, and because of that, everyone's kind of phased. Geoff spoke about something that's really key. There's how many quotes of how many lenders there are in Canada? 75, 95, 8 million. The fact is that most brokers have about 4 or 5. They do most of their business what they're comfortable with. They fit their clients, and there's all sorts of reasons why they do that. And I think that First Line went from being one of everyone's 5 to slowly being no one's 5. So that's why, Geoff, I 100% agree with you. I think it's not going to have a huge effect. I don't want to take credit for the comment because I know it was between Geoff and I kind of via some social media, but you mentioned, are we going to see CIBC back in the broker channel? They have, do the opposite of the Bank of Montreal's and actually re-enter.
Where will you move, or where did you move that business? Spread it out, or was there one product? Did you do a lot of matrix mortgages when you were? It's
funny. I made actually, to bring it up, that we're kind of going to a different route. I chose to actually place a portion of my business into a retainer model. So
Good
not
work.
all of it, just part of it.
Good work. Yeah. Okay. What about the points? Any thoughts on what's going? There's these massive shopping points and points to buy down rates. Anybody heard anything on whether they're going to disappear or?
No, we get those monthly statements, and mine usually go into the shredder because it says 0 on it.
Oh, okay. Okay.
I've been away from First Line for quite some time. I had hit a couple other statuses, but for us, it's always about relationship. And you spoke to it with regards to the 4 or 5 lenders, and for us, it's probably about 6 that we are dealing with on a daily basis. There's a relationship there with the underwriter, with their business development manager, and products really take the label off of one, slap it on the other. There's not a ton of difference between them. You have a line of credit in some, you don't on others, if it's a variable, but the features are generally the same. So it's about the relationship and what's the best fit for your client. Okay. Different rules.
Right. And Geoff, are you concerned of about any other lenders leaving the broker channel at this time?
No, only because I wouldn't really know what's in their minds.
Okay.
Nobody has certainly provided the same kind of overtures that First Line had about their plans for the business. In terms of the points that you mentioned, I think for those brokers that have got points left, I wouldn't plan on thinking those have
for
current
Christmas?
value. Yeah. So I think that most people, where it was important to them, they've probably already been proactive and made sure that they've used
as
those.
much printer ink as possible.
Well, done what they need to do, either for their customers or for themselves, to make sure that they're well protected. But to your point of where did that business go in the last year, I think if you look at Philogic's market share content, it kind of tells you.
Yep.
Some of that matrix business probably found its way to National Bank. Some
The
of that
all-in-one?
fixed term business probably went to some new entrants, the ICICIs that were price aggressive, Montana probably recently, who's come on strong. So there's probably a displacement, but you can probably just see, sort of pre-middle of last year where the market share numbers were and where they are now, and you can kind of almost see where the volume sort of went, right? because the top three have kind of, they are what they are, and then there's kind of a displacement
Filling
of
out,
shares.
yeah.
Yeah, exactly.
So the servicing of those mortgages, was that under a first line umbrella and they'll now be shifted over to CIBC?
That's certainly the way that the sale proposition was made to the marketplace, is that we were selling an origination
Right.
portal, and
Right.
we weren't selling our book of business, and that is CIBC Mortgages. So
Yeah.
my guess is they'll probably administer that through their own customer service units in CIBC.
So a lot of people are going to be out of work. So-
It's funny you bring it up. I service my clients on an ongoing basis, and First Line was one of those lenders that allowed us as brokers to have a consent form and continue to work on the client's app
Right.
after funding.
Right.
And so, because at one point I did do a lot of First Line business, I still have some clients there. I still have contact with the customer service section. And I think a lot of those customer service and all those people, they actually already work both sides. So they're not going to be out of work. They're just not going to have to worry about First Line anymore. It'll just be CIBC.
Okay, all right. So when we talked about touching our clients so many times a year, I mean, we've talked in this panel before. Troy, just out of curiosity, what's your strategy in terms of touching your clients?
Well, again, I'm focused on the relationship. I want to be there, but not always in their face. And so the monthly newsletters don't really work for me, but I'll try and bring information like today where we have something that's really making an impact in the market and going to change the way that we're doing business. That's timely. And so those types of opportunities are when we want to go to our client. Of course, social media is such a huge part of what we do now, and just finding the time to be able to make sure that engine's constantly being updated and running smoothly is really a part of what we're doing. A lot of people, we see comments coming back via Facebook and via LinkedIn and Twitter, and people are following. So that's something that we've invested a lot in the last couple of years.
Okay.
But I think it's important to be talking to your clients regularly, and it's a needs-based for what's that client looking like, what was the expectation that you set up with them when you did their mortgage. And so for us, it's usually at least a semi-annual thing.
Okay.
We talk to clients about having that semi-annual review, and sometimes it's just hey Troy, how are things? It's okay right now. We'll talk to you next year.
Right, okay, great. I'm always interested in, there doesn't seem to be one sort of database out there that we as an industry have jumped on, and just curious, with
Not
all the
yet.
social media, sorry?
Not yet.
Not yet?
No.
With all the social media out there, do you still maintain your database, and do you just use an Excel spreadsheet, or do you use ACT, or what do you use?
I've used a bunch of different things, and you know what? I'll forward the database question to the expert, Geoff.
Yeah, there we go.
Well, we're fortunate to have an operating system that runs both our process as a brokerage and also runs it as a client database.
Okay.
So we have done this thing where we've tried to ring fence everything we'd want to know about our client and put it in one place and then extract things as we need it. And it served us really, really well. Interestingly enough, though, I think in what's going on now, I'm actually thinking the inverse. And if you read, even the newspaper this week, there was all these things in the Vancouver Sun about people not connecting personally and neighborhoods not interacting. And I think we have the best chance as brokers ever to elevate our proposition to referral partners, to consumers, to builders, and do it sort of face-to-face, one-on-one, and actually bring the needs of this personalized service back front and center. And I know it's more work and it's more painstaking because you're not just broadcasting, but I think what it'll do a lot to preserve what it is we really bring to the party, which is unbiased advice, somebody in your corner, somebody that disseminates all of this PR type stuff that comes out from the government and from lenders and makes it meaningful for somebody in their day-to-day life.
Okay.
So, as a business, I think we're going to do more to try to say, how do you make this personal to your referral partners, to your clients, more town hall meetings, more things that we do even as a communications plan through our membership of MBABC to make this a personal face-to-face business. I think that's a great chance for us to really make ourselves look better as a channel in the eyes of the lender and in the eyes of the consumer.
Yeah.
Good point.
I totally agree with Geoff. That's one thing I've focused on now too. There's always I really think some of the great brokers have always tried, whether it's when they take the application, when they go over the documents, and that kind of the actual real transaction, the ones that do something face to face. But Geoff, you brought up a good point. It's that step further. It's that when you do your annual review, why don't you do it in person this time?
Right.
And make those connections and do those things. Host garage sales and really get involved with your clients. that's where you're really going to see. I mean, I said this last time. You know, what's the one? What? How do you connect with your clients? Call them. Like actually
Pretty
just
simple. Pretty simple.
like actually
speaking.
You know,
Just
actually
not
call them.
thinking about it,
Yeah.
doing something
just,
about
just
it.
doing something about
Yeah.
it. The funny thing is about databases, whether it's Geoff's system or anything, I just think you got to get something. You know, there's people that just have files and files and files of potential business, people they could take care of. So even if it is just an Excel spreadsheet, then get an Excel spreadsheet, something
Do
that
something,
you can keep track.
right.
Yeah.
Okay.
Yeah, and I think important thing to let all brokers know that might be watching this or think about it later is that social media, it's a given. Like you have to be in it. It's just a rule of entry.
It's not an option
But
anymore.
it isn't going to set you apart
No.
because you did some really cool post or you did a real cool video. It's the cumulative effect of people checking you out when they're deciding who to pick.
Right.
But it's what you do with the people
It's that
once they
value
start
added,
interacting with
right?
you. Everybody.
Absolutely.
Right, that really sets you
That's a good
apart.
point.
Yeah, it's what you bring to the process, not what your various marketing initiatives are bringing to it. Yeah.
So just have a question that's come in, and I'm sort of doubling back to the changes that occurred last night, wanting to know whether conventionally these changes will take effect. Will the banks be forced to go from 30 high ratio down to 25 as well as conventional? Somebody want to make a comment on that?
Well, back to what I said before, and my contacts were, we'll find out later today.
Okay.
No one knows right now exactly. I mean, as we know, there are still, whether it's credit unions in BC who are still dropping 35-year amortizations, or some, Merrick's who still does an extended amortization on a conventional basis, will they still be allowed? We don't know.
Right.
And I think it'll be tailed of the afternoon when the VPs and the guys at all the lenders get to have their conversations with the Genworths and the CMHCs and find out if they're allowed or not.
Okay. All right.
I think it'll be driven primarily by the investment community. Could we still sell off our balance sheet a 30-year amortization into a mortgage-backed securities pool? You know, and that's an easier decision for a universal bank who can keep it on their balance sheet, but a more difficult decision for a lender who has to take it off their balance sheet.
That's
So,
right.
unfortunately, it won't necessarily be driven by the things we would think are, sort of normal
investor
business
pool.
acumen. Yeah, the investment part of it.
I remember last time that when it went down to 30, immediately all the banks went 30 high ratio and conventional in panic mode.
Yes.
Yeah.
And then they kind of relaxed a little bit and said, hey, wait a second, we could probably be a little more flexible conventionally. So it'll be interesting to see if that's
And
what's going
sometimes
to
we
happen
don't
going
think
down
of
the
the
road.
other implications, like the idea of having a system that has to manage two different kinds of amortizations, one for conventional, one for high ratio, when they try to systemize everything within the bank, that can be a challenge in and of itself. So
Right.
it's not like they don't want to do it, it's just, how do we do this? Now we have to timestamp when the deal came in, when it funded. So sometimes those become
It's an
part of the-
administrative nightmare.
Exactly, they become
Right.
part of the criteria that we go, well, I just don't get why they don't do it. Well, because there's other stuff that affects them that we don't really think about, right?
Seems to be mostly investor driven though. They're going to make their decisions based on the pools of funds that are available. If they've got an investor that's willing to take 35 still or 30 still, then there'll be a demand and a need for it and they'll serve that.
Right.
If there's not,
Good point.
it'll go away.
Okay. All right, gentlemen, I think that just about wraps it for today. I also believe that the MBABC directors are going to enjoy a very nice summer vacation. So we probably won't be seeing you again until the fall. I'm just assuming.
Okay.
I could be
Hoping.
wrong.
Yeah.
I see some head shaking in the background. I'd also like to mention in closing that the MBABC is hosting their annual MBABC Golf Charity this year out at Mayfair Lakes on September 10th this fall. I guess that's not fall yet, it's still the summer, September, if we ever get summer.
Yeah.
And registration is set to go live next week, so log on to that MBABC website and get your foursome booked. So thanks for watching, and we'll see you again in September.
Bye.